Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.
This website makes learning so easy. I found all my resources here.
Like what you share.
Welcome to this explainer. Today, we're jumping right in to bridge this really fascinating gap between strict accounting frameworks, complex econometric formulas, and the actual real-world earnings manipulations that shape our capital markets. If you've ever wondered how internal corporate accounting data actually translates into equity valuation and how managers navigate or even manipulate that data, well, you're in the exact right place.
Here is our roadmap for today. We'll be moving through core statutory accounting frameworks, valuation and earnings models, a synthesis of empirical literature, and finally, implications for capital markets.
All right, kicking things off with Section 1, Core Statutory Accounting Frameworks. Let's look at the foundational rules of the corporate reporting game.
We have to start with IND AS 1. This standard does something absolutely crucial. It strictly isolates unearned fair value adjustments, we're talking things like actuarial gains or revaluation surpluses, over into other comprehensive income or OCI. Now, why does that matter to us? Because it prevents all that artificial mark-to-market volatility from polluting a company's core operating earnings in the P&L. It's all about protecting the true economic substance of the firm's reporting from transitory noise. Moving on to revenue, INDAS 115 introduces this really beautifully structured 5-step architecture. The big game changer here is that this framework shifts the entire focus of revenue recognition straight to the transfer of control, moving away from the old, slightly murky model of just transferring risks and rewards. You simply walk the steps, identify the contract, unbundle the performance obligations, determine and allocate your transaction price, and then, only when control actually transfers, do you recognize the revenue.
And this is where it gets really elegant. Under INDAS 109, we have this dual criterion test for financial instruments that acts like a logical decision tree. First, you look at the asset's cash flow characteristics. Does it pass the SPPI test? Meaning, are the cash flows solely payments of principal and interest? If the answer is no, bam, it goes straight to fair value through profit or loss. But if it passes, then the entity's actual business model dictates whether it sits at amortized cost or FVOCI. Still on INDAS 109, it totally overhauls asset impairment. We finally threw out the old backward-looking incurred loss model and replaced it with a forward-looking expected credit loss, or ECL, framework. Loss provisions are now spread across 3 distinct stages. Notice that massive jump from Stage 1 to Stage 2. Once a firm identifies a significant increase in credit risk, their provision has to jump from just a 12-month expected loss to a lifetime expected loss. That is a massive shift in reporting mechanics that analysts have to watch closely.
Wrapping up this first section, let's talk consolidation. Under INDAS 110, consolidation relies entirely on a very specific definition of control. To consolidate, an investor needs a powerful trinity: power over relevant activities, exposure to variable returns, and the linkage between the two, meaning they have the ability to actually use that power to directly affect those returns. If even one of those 3 pieces is missing, there is no control. So we know the rules, but how do we translate those rigid frameworks into actual equity value? That brings us to Section 2, Valuation and Earnings Models.
To really anchor us, we have to look at the Olson valuation model from 1995. This isn't just some abstract theory. It's a rigorously derived mathematical bridge combining the dividend discount model with the clean surplus relation. It literally proves mathematically that a firm's market value is fundamentally anchored to its current book value plus the present value of its expected future abnormal earnings.
Here is that residual income equation in action. Think of these variables like characters in our story. Firm value is our ultimate goal. Book value is our solid anchor. Then we have Alpha 1, which scales the persistence of abnormal performance, and Alpha 2, which captures forward-looking, non-accounting information. It's such an elegant way to show that a company's value is simply today's verified reality plus tomorrow's expected extraordinary performance.
But here's the catch. Managers know this math too, right? And they generally choose from a menu of two options to manipulate these inputs. On one hand, we have accrual earnings management, captured by the modified Jones model, where managers make accounting tweaks post-period end, things like altering credit provisions. It doesn't actually impact cash. On the other hand, we have real earnings management, modeled by Roy Chaudhary. This is where managers make actual operational cuts intra-period, like slashing R&D or purposefully overproducing inventory. That directly drains actual cash flows.
So how do forensic analysts catch this? They rely on specific econometric models, hunting down statistical residuals hiding within these regression formulas. If an analyst suspects accrual tweaks, they'll fire up the modified or performance-matched Jones models, looking for non-zero residuals in total accruals. But if they suspect real operational meddling, they'll turn to the Roy Chaudhary model to track residuals in abnormal cash flow, abnormal production costs, or abnormal discretionary expenses.
But you know, theory and math really only tell half the story. Let's move to Section 3, Synthesis of Empirical Literature, and look at how real managers behave under pressure.
First up, how does the market actually price fair value disclosures? Research by Song and colleagues reveals this fascinating descending staircase across the fair value hierarchy. Level 1 inputs, your active market prices, are priced near 1-to-1 ratio. But investors heavily discount Level 3 assets. Why? Well, because Level 3 relies on unobservable, entity-specific models. It essentially gives managers room to inject their own bias. But interestingly, the research points out that strong corporate governance, like a highly active audit committee, actually restores credibility and significantly reduces that Level 3 market discount.
Now this right here is probably one of the most fascinating behavioral realities, the substitution effect. Empirical studies show that when regulators turn up the heat, maybe through stricter audit enforcement or mandating frameworks like IND-IS, managers don't just magically stop managing earnings. They just switch menus. They substitute easily detectable accrual adjustments for real earnings management. Because external auditors find it incredibly hard to challenge a real business decision, like a strategic price cut, managers resort to operational manipulations that actually degrade the firm's long-term economic cash flow.
And we see this exact same behavioral game playing out with the new forward-looking expected credit loss models. The ECL model is definitely more resilient, but standard setters didn't mandate a hard quantitative threshold for what constitutes a significant increase in credit risk. So managers exploit that gray area. They might delay moving an asset from stage 1 to stage 2 just to avoid that massive lifetime ECL hit, or they adjust macroeconomic forecast weights to build cookie jar reserves during boom times, which they can smoothly release later to pad their earnings during a downturn.
Okay, let's bring it all together in our final section, implications for capital markets. What does all this structural and behavioral complexity mean for anyone actually trying to analyze corporate health?
The absolute biggest takeaway here is that financial reporting isn't just a static historical record. It is a highly dynamic measurement framework deeply influenced by managerial choices. Analysts absolutely must integrate their detection models. If you are only looking at accrual models, you are going to completely miss the real operational manipulations like overproduction that actually destroy long-term value. Analysts have to adjust their fundamental models, intentionally isolating core, recurring earnings from both accrual noise and real activity distortions, all while keeping a close eye on corporate governance as a vital quality check.
Which leaves us with this final, critical question to ask yourself the next time you're digging into a company's financials. Are you valuing the company's true underlying economic reality, or are you just valuing the manager's strategic accounting choices? It is a very fine line, and understanding the frameworks, the math, and the human behavior behind it is the only way to tell the difference. Thanks for joining me on this explainer, and remember to always keep questioning the numbers.
Like what you share.
This website makes learning so easy. I found all my resources here.
Noir Plasma Chrome Bleed. Unlocking knowledge, inspiring innovation, empowering curious minds.